Most people going through a divorce think that buying out an ex means starting over financially. In most cases, there are options depending on what you want to do with the house, what your future plans are, and what the requirements of your settlement agreement are. So, I'm Rebecca Richardson, aka the Mortgage Mentor, and I'm going to walk you through what happens when real estate meets divorce and what you can do to help set you up for the future. So, let's get into it. So, usually the situations I see with my clients are that they own a home and one of the parties wants to stay in the home. A lot of times it tends to be the wife. She wants to stay there, keep the house for the kids, keep as much stability as possible. And particularly if it's something that, has been bought within the last couple of years, there's a significant amount of equity that comes into that. And what I'm seeing is that in most situations, there's significant equity in the property that also needs to be accounted for. So usually when you're working with an attorney, whether you're going with a mediation or each of you have an attorney, you're going to lay out all of your assets on one side and all your liabilities or debts on the other. So everything from the standpoint of cars, auto loans, homes, mortgages, assets. So that might be 401ks, that might be Roth IRAs, that might be general brokerage accounts, checking, savings, credit cards, student loans. All of that is basically put on a balance sheet to try to figure out what is going to be an equitable division of those assets, also factoring in the debt. Now, what I find a lot of times with the house is it's the home, right? So there's certainly a lot of emotion tied into that, but there's also a big financial piece of that. Because on paper, it might be great to have that much equity, kind of in your pocket, in your column as far as asset column, but it's not necessarily money that you can tap right now. So for the examples that I'm going to go through, let's say that the house is worth $400,000 and you owe $300,000 on it. So there's $100,000 equity available. So making the math simple, you would think I need $50,000 to buy out my ex. So there are different parts that we want to talk about in terms of what happens with the home. Yes, you've got the equity, but you've also got who's on the loan. So sometimes the loan may be joint, sometimes it may just be in one spouse's name. When we're talking about that, one thing to consider from the equity standpoint is a lot of people think, okay, let me tap into or let me take less from liquid assets like checking, savings, retirement funds, investments, etc. What you want to think about though from the standpoint is taking that money out of the market where it's potentially making money for you and giving it to your ex might not be the best decision long term. That's where when you're talking with your financial advisor or just running the numbers, you want to think not about just what the numbers are now, but what they are going forward. The other thing is making sure that the debt is basically cleaned up. So what I absolutely do not recommend is deeding over a property or taking your name off the title of the property while you're still on the mortgage for the property. So I have seen that. It gets very messy because your mortgage is a significant part of your credit score, and you really don't want to have a debt that is in someone else's control but is also still in your name, because those late payments, or if there are late payments, then that would severely impact your credit and it's something you have no control over. So typically when we're thinking about the house, there are three main pathways. It's you can refinance to get the ex off. You could refinance to get equity to also buy out your ex's equity, or you can sell the property. So when we're talking about refinancing, and that's truly just from the standpoint to get the debt only in the person's name that is going to be responsible for the home, that's living in the home, etc. So that just takes care of that piece from the standpoint as far as putting the debt only in one person's name. If that's all that you're doing and you're not taking out any extra cash to tap into the equity to buy out your ex, then that's just considered a rate term refinance. And you're going to be getting a new mortgage that is based off of current market rates. And it's kind of a traditional refi, no real drama there, no extra stipulations or things to be, considered from that standpoint. The second thing is, what if you do need to tap into the equity to buy out your ex and you don't want to use other assets like we talked about, checking, savings, investments, etc. There are two ways really that you can tap into the equity that you may want to consider. The first one is sometimes people will want to get a home equity line of credit. So that's going to be a second mortgage that you're getting. It does nothing to your first mortgage, so it doesn't change any of the details of your first mortgage, but it's kind of like a credit card that's sort of tied to your home. And then that allows you to draw however much money off of it that you need. In the example that we're talking about, if there's $100,000 equity, you're getting $50,000 for the home equity loan. And then that is the money that is then being given to the other spouse to buy out their equity in the property. Now, pros and cons of that. So, if your rate on your first mortgage is significantly lower than what current market rates are, then that could make sense because that's going to keep your payment lower. However, keep in mind that with home equity lines of credit, with HELOC rates, they are typically higher, somewhere anywhere, right now in the 9 to 11 range, sometimes higher, depending on all the details of the loan. So it might not be as equitable, or it might not be as favorable as it seems if you're only focused on that rate that you have on the first mortgage. Keep in mind that if on that mortgage that is existing, if that's in the other spouse's name or if it's a joint debt, it's going to remain that way. It's going to remain in the other spouse's name. And if you're the person that's taking over the mortgage, paying the mortgage, living in the home, and your name is not on the mortgage, if you have questions about it and you call, the lender will not speak to you without permission of the person that is actually on the loan. The other thing to keep in mind too is, again, if you have that joint debt, then that's in control. You're in control of that payment. The other person doesn't have control of that payment, and it can get a little messy. So that's one thing to keep in mind from that strategy. The other strategy that you can do if you want to leverage your home to buy out that equity is it is still considered a rate term refinance, but it is considered an equity buyout. Now, why do I keep coming back to talking about a rate term refinance? It's because a rate term refinance will get you a better rate and term than a cash out refinance. So there's a special stipulation with conventional loans that if you are buying out another owner of the property, in this case, spouse, and they have been on title for at least 12 months, instead of being capped out at 80% of the home's value, which would be the case if you were just doing a regular cash out refinance, then you can actually go up to 95% of the home's value with the special stipulation. So the reason that helps is if the home is worth $400,000 and a normal traditional cash out refinance caps us at $320,000, that's not going to get you enough equity to buy out that full $50,000 equity if there's $100,000 there, right? So you have a balance of $300,000, value is $400,000, where are you coming up with the extra $30,000? With this special stipulation of a rate term refinance when you're buying out a spouse, you can go up to 95%, and you're not hit with higher rate, higher terms, higher closing costs, basically, by doing that. So that is a very helpful tool to have in your back pocket if that's a situation, where you need to buy out your ex. Now, the other option is selling and splitting the proceeds down the middle. So sometimes the reason that happens is it may be that spouses want to move, or the people want to move, or it may be that the payment is too much to qualify for on one person's income. So this is where it's very, very important if you are going through a separation, heading for divorce, and you're talking about all the things that you may want to do or the things that you need to do with your house and your mortgage, is to talk to a mortgage lender before you're coming up with a plan with your attorney or even just between yourselves. Because you want to make sure that whatever is going into that agreement is going to be something that meets mortgage guidelines and that you're going to be able to accomplish. The reason that I recommend bringing in a lender early is because the things that lenders care about are going to be things like ownership transfer, the parties that are responsible for it. Do you have a signed agreement stating what the stipulations are or what the agreement is to buy out the equity? And then also the ability to qualify solo. So a lot of this work can be done up front to make sure that whatever you put in your agreement can actually be carried out the way that you want it to be. So working with clients going through divorce, I see three main mistakes that get made. The first one, and I know I sound like a broken record, is waiting until the divorce is finalized or waiting until that paperwork is finalized to coordinate or to talk with the loan officer. And simply because sometimes what's good for family law or what makes sense on paper just can't be carried out the way that it's intended because, again, of underwriting guidelines. So it's helpful to have that information up front to make sure that what you're putting in the agreement can be acted upon. The second one is making decisions based off of emotion and not numbers. And I do understand this is a very, very emotional time and everything is being affected. So you absolutely feel like you are, you're in, because you are dealing with everything all at once. But what I want to remind you is that the decisions that you're making now really do have long-term impact. So it's not just, can I squeeze everything in my budget to hold on to this house? I want you to step back and think, is this really the best decision for me, for my family? So sometimes that does mean that a cleaner thing is to sell the house and split the proceeds. But the flip side of that coin is a lot of times people think that the cleanest way basically to divide up their property or divide up the debt and the assets is to sell. So it's such a personalized thing that I recommend that you look at it from the standpoint of not just what necessarily looks good on paper right now and what looks very clean and easy, but think about what you actually need going forward long term and what's going to serve you long term. So the biggest point that I want you to take home is that buying out an X might feel really complicated, but it's not. It's just, it will go a lot smoother with a little bit of pre-planning to understand what your options are and which of those options are your personal best option based off of what your goals are. Please comment with any questions. Be sure to subscribe, and I'll see you next time.